Good morning and welcome back to Money Markets from True Potential. Today we're going to be focused on the Bank of England's decision to raise interest rates. Yesterday we had the Bank of England decision to raise interest rates by 0.5%, moving the base rate up from 4.5% to 5%. And that's on their quest to really bring down inflation. On Wednesday, we had the latest UK inflation report, which came in higher than expected, a lot more stronger than expected. When we look at headline CPI inflation, that remained at 8.7% year on year. So no change. The market was expecting inflation to fall further. That wasn't the case. When we look at inflation and strip out volatile components such as food and energy, core inflation, that actually pushed higher from 6.8% to 7.1%. So the UK has an inflation problem. It's at its highest in over 30 years, and that's because of stronger contributions from higher prices on the services side. Wages are also growing fast, and that's pushing inflation up. So the Bank of England met yesterday, decided the 9-member committee voted in favour to raise interest rates by 0.5%, 7 in support of it, 2 wanting to hold interest rates flat. So that puts interest rates at its highest level in 15 years. Comments from the Bank of England Governor, Andrew Bailey, talked about the UK economy being slightly stronger than previously thought, but inflation remains far too high. Reading through the minutes that were released, there was a sense that the Bank of England are going to be focusing more on the actual inflation numbers rather than the previous surveys that they've been using and placing more weight on, just given that inflation has been surprising to the upside on a number of occasions. When we look at the market had now priced prior to the meeting, given the inflation report, that interest rates were going to have to go up by around 0.5%. So there was not too much of a surprise. Looking forward, the market's still expecting interest rates to go higher, currently pricing an additional 1% by the end of the year. So getting to around 6% for a base rate, which does seem very high given a slowing economy. What that means for UK households, those with mortgages, it does mean that mortgage rates will have to go up, which will be increasingly problematic given the number of fixed mortgages that will have to be renewed. And towards the end of this year, we'll expect to see about 800,000 fixed mortgages be up for renewal, which means that previously, mortgage owners will probably be sitting on interest rates of around 2.5% or less. They'll be having to be pushed much higher, which does mean that the amount of disposable income households have will be reduced. So the UK does have an inflation problem, but when we look outside of the UK, when we come to investing, we're very much global investors. When we look at the US, we're seeing inflation continuing to trend downwards. It peaked at 9% last year. It's currently at 4%. When we look in Europe, they're also seeing improvements on inflation as well. When we look at France, Germany, and also Spain, they've seen inflation come in below economists' expectations. So there is more positive news outside of the UK, but the UK seeing interest rates go up and in order to try and bring inflation down. That's everything from us today. Thank you for watching and have a great weekend.